Listen, something extraordinary is happening in the silver market right now. And if you're holding physical silver or thinking about it, the next 72 hours could define your position for the next decade. I'm not being dramatic. I'm looking at data that most people won't see until it's too late. Let me start with what just happened yesterday. The COMEX silver warehouse stocks dropped by 1.2 million ounces in a single session. Now, you might think that's just normal market activity, but here's what makes this different. This is the 7th consecutive day of withdrawals exceeding 1 million ounces. We haven't seen this pattern since March 2020, right before silver exploded from $12 to $30 in less than 5 months. But that's just the surface. What's really happening underneath is far more significant. There's a man named Ted Butler who's been analyzing the silver market for over 35 years. He's the guy who first exposed the silver manipulation back in the 1980s, long before anyone was paying attention. Last week, he published something that made my jaw drop. He's identified what he calls the final squeeze, a convergence of factors that he says happens maybe once in a generation. Here's what he's seeing. The commercial short position on the COMEX has collapsed to levels not seen since 2003. Back then, silver was trading at $4.50 an ounce. Today it's around $31. But the commercial traders, the big banks that usually suppress the price, they're not just reducing their shorts, they're actually going long. JP Morgan, the same bank that paid $1 billion fine for manipulating precious metals markets, has quietly accumulated what Butler estimates to be somewhere between 800 million to 1 billion ounces of physical silver over the past decade. Think about that for a second. Why would the same institution that spent years suppressing silver prices suddenly become the world's largest private holder of physical silver? They know something, and that something is about to become obvious to everyone else. Now, let me show you what's happening in the industrial sector, because this is where the story gets really interesting. Silver isn't just a monetary metal anymore. It's become absolutely critical to the technology that's defining our future. Every solar panel requires about 20 grams of silver. Every electric vehicle uses between 25 to 50 grams depending on the model. 5G infrastructure? Each small cell tower uses approximately 30 grams of silver. The Silver Institute just released their 2025 forecast, and the numbers are staggering. Industrial demand for silver is projected to hit 690 million ounces this year. Total mine supply? About 830 million ounces. Investment demand is running at 240 million ounces. You don't need to be a mathematician to see the problem. We're looking at a structural deficit of roughly 100 million ounces this year alone. But here's where it gets critical for the next 3 days specifically. There's a major options expiration happening on Friday. Over 45,000 silver contracts are set to expire, representing 225 million ounces of silver. Now, normally, most of these contracts get rolled forward or cash settled. But something unusual is happening this month. The percentage of contracts standing for delivery is running at 23%, compared to the usual 3 to 5%. What does that mean in plain English? It means that holders of these paper contracts are demanding physical metal. And the COMEX doesn't have it. Those warehouse withdrawals I mentioned earlier? That's scrambling to find metal to deliver against these contracts. I want to tell you about something that happened in 2008 that most people have forgotten. In March of that year, Bear Stearns collapsed. Everyone remembers that. What people don't remember is what happened in the silver market that same month. The premium on physical silver over the paper spot price exploded to $6 per ounce. You could sell a paper contract for $17, but if you wanted to buy a physical coin, you were paying $23. The market completely disconnected. We're starting to see the early signs of that same disconnect right now. The premium on American Silver Eagles is running at $5.50 over spot. Canadian Maples are at $4.80 over spot. These are the highest premiums we've seen since 2020. And more importantly, delivery times are stretching out. Major dealers are quoting 3 to 4 week delivery times for products that used to ship in 48 hours. There's a dealer I know in Texas, been in the business for 30 years. I called him 2 days ago, and he told me something that gave me chills. He said, "I've got customers offering me $2 over my asking price if I can deliver this week instead of next month." I've never seen that before. People are panicking to get physical metal, and they don't even know why yet. That why is what I want to explain to you, because it's not just about supply and demand. It's about something much bigger that's happening in the global financial system. You've probably heard about BRICS, Brazil, Russia, India, China, South Africa. What you might not know is that they're planning to launch a new trade settlement currency in August of this year, and it's going to be partially backed by gold and silver. The details are still emerging, but leaked documents suggest a 40% backing by precious metals. If even half of the BRICS trade volume shifts to this new system, we're talking about demand for thousands of tons of gold and silver that has to come from somewhere. China understands this better than anyone. Their silver imports in the first quarter of 2025 were up 67% compared to the same period last year. They imported 1,847 tons of silver in January alone. That's not for jewelry. That's not for industrial use that can't be sourced domestically. That's strategic accumulation. And here's something that should terrify anyone who's short silver or sitting on paper promises. India just announced a reduction in import duties on silver from 15% to 10%. India is the world's second largest consumer of silver, primarily for jewelry and religious purposes. This duty reduction is projected to increase imports by 30 to 40%. We're talking about an additional 2,000 to 3,000 tons of silver flowing into India this year. Where's that silver going to come from? The mines can't produce more. Silver is primarily a byproduct of copper, lead, and zinc mining. You can't just mine more silver when the price goes up. It doesn't work that way. It takes 7 to 10 years to bring a new mine into production. Now, let me connect this to something that affects you directly, especially if you're thinking about your retirement security. The dollar is losing its grip as the world's reserve currency. I know you've heard this before and maybe you're tired of hearing it. But look at what's actually happening, not what the financial media is telling you. Saudi Arabia just completed its first oil transaction with China settled in yuan. That's not a headline. That's an earthquake. The petrodollar system has been the foundation of American financial dominance since 1974. When that system breaks down, and it is breaking down, the dollar's purchasing power is going to collapse in ways that most Americans can't even imagine. Quick aside here, if you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers how to get physical precious metals into your retirement account without tax penalties, and more importantly, how to protect your purchasing power from what's coming. Worth checking out if that's relevant to your situation. Back to why the next 3 days matter so much. There's a technical setup happening right now that I've only seen twice before in my career. Silver is consolidating in a tight range between $30.50 and $31.80. The Bollinger Bands are squeezing to their tightest level in 8 months. The last 2 times this happened, in November 2010 and July 2020, silver exploded higher within 72 hours of the squeeze completing. In November 2010, silver was trading at $26. Within 6 weeks, it hit $49. In July 2020, silver was at $18. It hit $30 in less than 4 weeks. Both times, the Bollinger Band squeeze preceded the move by exactly 3 days. Now, I'm not saying history repeats exactly, but I am saying that the technical setup is identical, and the fundamental backdrop is actually more bullish now than it was in either of those previous instances. Here's what's different this time: the gold to silver ratio. Right now, it takes about 88 ounces of silver to buy 1 ounce of gold. The historical average is 60 to 1. In 2011, when silver hit its peak, the ratio got down to 32 to 1. Even if we just revert to the historical average of 60 to 1 and gold stays exactly where it is at $2,650, silver would need to trade at $44 per ounce. But gold isn't going to stay where it is. Central banks bought 1,037 tons of gold in 2024, the second highest year on record. They're buying another 800 plus tons this year. The central banks of Poland, Czech Republic, Singapore, and India have all announced increased gold purchases in their 2025 reserve management strategies. Why does this matter for silver? Because silver is gold's little brother. When gold moves, silver moves harder. The beta on silver to gold is typically 2 to 3 times. If gold goes up 20%, silver historically goes up 40 to 60%. And right now, gold is setting up for a major breakout above $2,700, which would target $3,000 by year-end, according to most technical analysts. Let me tell you about a conversation I had with a fund manager last week. This is a guy who manages $2.3 billion in commodity investments. He told me something off the record that I think you need to hear. He said, "We're getting calls from family offices asking about silver exposure. Not gold, silver. These are people with $500 million to $2 billion in assets, and they're asking about silver. That's never happened before in my 20-year career." Why are the ultra-wealthy suddenly interested in silver? Because they're looking at the same data I'm showing you. and they're reaching the same conclusion. Silver is the most undervalued hard asset on the planet right now. Think about this. Silver is trading at roughly the same price it was in 2011, 14 years ago. Meanwhile, the money supply has increased by 40%. The national debt has doubled. Real estate prices have gone up 60%. Stock prices have tripled. But silver? It's basically flat. That's not a market. That's a coiled spring. Now here's where the 3-day window comes in specifically. This Friday's options expiration is going to force the hand of the commercial traders. They either have to deliver physical metal or they have to buy back their short positions at a loss. Based on the current open interest and the percentage standing for delivery, we're looking at potential buying pressure of 50 to 60 million ounces hitting the market between now and Friday afternoon. In a market that trades about 150 million ounces per day on the COMEX, that's enormous. And remember, the physical market is already tight. Premiums are elevated, delivery times are extended. The COMEX warehouse stocks are declining. This is a powder keg, and Friday's expiration is the match. But here's what most people don't understand about these situations. By the time the move happens, it's too late to position yourself advantageously. When silver gapped up from $18 to $22 in July 2020, it happened overnight. Asian markets opened, and boom. The price was already up 20%. If you weren't positioned before that gap, you missed the easiest part of the move. I want to share something that happened in 1980 that I think is incredibly relevant right now. The Hunt brothers were trying to corner the silver market. Everyone knows that story. What people don't know is what happened in the 3 days before silver hit its peak of $50 per ounce. On January 14, 1980, silver closed at $34. There was a weekend. On Monday, January 17th, it opened at $42. By Wednesday, January 21st, it hit $50. 3 trading days, a 47% move. And here's the key. The people who made life-changing money weren't the ones who bought on Monday at $42. They were the ones who were already positioned before the weekend. The smart money had been accumulating for months while everyone else was ignoring silver. They understood that when a market that's been suppressed for years finally breaks free, it doesn't move in an orderly fashion. It explodes. Now, I'm not predicting that silver is going to $50 in the next 3 days. What I am saying is that the setup right now has eerie similarities to previous moments when silver made violent moves higher, and those moves always started with a catalyst that forced short covering in a tight physical market. Let me show you what's happening in the mining sector, because this tells you everything you need to know about where the smart money thinks silver is headed. First, Majestic Silver, one of the largest primary silver miners, just reported their first quarter earnings. Their all-in sustaining costs are $23.50 per ounce. They're making less than $8 per ounce at current prices. That's not a sustainable business model. And yet, their stock is up 34% year to date. Why? Because the market is pricing in much higher silver prices. The equity market is front-running the physical market. That's exactly what happened in 2010 before silver's big run. The mining stocks moved first, then the physical metal followed. Here's another data point that's fascinating. The short interest on the major silver ETFs has dropped by 40% in the past 2 weeks. Short sellers are covering. These are sophisticated traders with access to information and analysis that most retail investors never see. They're closing their bets against silver. That's not random. That's positioning for a move higher. Now let's talk about what happens if I'm wrong. What's the downside risk here? Silver has strong support at $28. That's been tested 3 times in the past 6 months and held every time. So if you're buying physical silver at $31, your downside risk is about $3 per ounce, or roughly 10%. What's the upside? If silver just reverts to its historical ratio with gold, you're looking at $44, which is a 42% gain. If silver catches up to where it should be based on monetary inflation since 2011, you're looking at $60 to $70 per ounce. If we get a genuine short squeeze combined with a BRICS currency launch and continued central bank buying, $100 silver is not out of the question. So you're looking at a risk-reward ratio of potentially 10 to 1 or better. In what other market can you find that kind of asymmetric opportunity right now? Stocks are at all-time highs. Bonds are yielding nothing after inflation. Real estate is unaffordable for most people. Crypto is volatile and speculative. Silver is the one asset that's both undervalued relative to its history and positioned at the center of multiple macro trends that are all pointing in the same direction. Let me tell you about a guy named Eric Sprott. He's a billionaire investor who made his fortune in precious metals. In 2020, he bought $1.5 billion worth of silver through his various funds and personal accounts. People thought he was crazy. Silver was at $18. Why would a billionaire put that much money into silver? Today, that position is worth over $2.5 billion. But here's what's interesting. He hasn't sold a single ounce. In fact, he's been buying more. His latest fund filing shows he added another 15 million ounces in Q4 of 2024. This is a guy who could buy anything. He's choosing to buy silver. The 3-day window I'm talking about isn't just about Friday's options expiration. It's about positioning yourself before the broader market wakes up to what's happening. Once silver breaks above $32 and holds, the technical picture changes completely. You'll see momentum traders pile in. You'll see retail FOMO. You'll see financial media finally start covering the story. But by then, the easy money will have been made. The move from $31 to $35 is where you make 13%. The move from $35 to $50 is where you make another 43%. But you have to be in position for that first leg to capture the second leg. Here's something that keeps me up at night: the possibility of a genuine shortage in the physical market. We've never actually seen what happens when the paper market breaks down completely and people demand physical delivery en masse. In 2008, we got a taste of it with those premium spikes. But the financial system was bailed out before it got really ugly. This time might be different. The COMEX has 280 million ounces of registered silver available for delivery. There are 950 million ounces of open interest in silver futures. That's a leverage ratio of 3.4 to 1. If even 30% of those contracts stand for delivery, the COMEX doesn't have the metal. What happens then? Either they change the rules, force cash settlement, raise margin requirements, limit position sizes, or the price explodes higher until enough longs are willing to sell. Either scenario is bullish for physical holders. If they change the rules, it proves the market is broken, and physical premiums will skyrocket. If they let the price run, well, that's obvious. There's a phrase in the silver community: if you don't hold it, you don't own it. That's never been more true than right now. The difference between paper silver and physical silver is about to become very, very clear to a lot of people. I want to end with this thought. We're living through the end of a monetary era. The system that's been in place since 1971, when Nixon closed the gold window, is breaking down. You can see it in the currency wars, the trade wars, the formation of alternative payment systems, the central bank gold buying, the rising distrust of institutions. When monetary systems break down, people flee to real assets. They always have throughout history. In Weimar Germany, it was gold and silver. In Zimbabwe, it was gold and silver. In Venezuela, it was gold and silver. The pattern is consistent across cultures and centuries. Silver is real money. It's been money for 5,000 years. It's in the Constitution as legal tender. It can't be printed, debased, or created out of thin air. And right now, it's trading at a price that doesn't reflect its monetary value, its industrial value, or its scarcity value. The next 3 days give you a window to position yourself before the market reprices silver to reflect reality. After Friday's options expiration, after the short covering, after the technical breakout, the opportunity will still be there, but it won't be at $31. It'll be at $35 or $40 or higher. The choice is yours. You can wait and see what happens and potentially pay a higher price later, or you can act now while silver is still in this tight range, while the physical market is still accessible, while premiums are elevated but not yet extreme. History doesn't repeat, but it rhymes. And right now it's rhyming with every major silver breakout we've seen in the past 50 years. The question is, will you be positioned when it happens, or will you be one of the people scrambling to buy after the move has already started? The clock is ticking. 3 days. Make your decision.